Welcome back, everyone, to Vox Markets. My name is Paul Hill. I'm delighted again to be able to speak to accomplished fund manager Sid Lall of Canaccord. So welcome, Sid.
Thank you, Paul. Thanks for having me one more time.
Yeah, well, we've had a ton of big data over the last few weeks, not least the UK and French general election results. We've got the US CPI later this week, I think on Wednesday, and then followed by the Q2 earnings starting up with all the big banks. But before we sort of like run through your view of the markets for the second half, I suppose you could quickly remind investors of what kind of stocks you like, what kind of investor you are.
Gladly. So I'm the manager of the Marlborough Multi Cap Income Fund. And as the name suggests, it looks for income, dividend-paying stocks, UK, across the market cap spectrum. And two of the things that we really sort of seek out are sort of the sustainability from good balance sheets. So sustainability of dividends from good balance sheets and also free cash flow covering dividends. So those are the two things that they don't have to be the case in every single stock, but generally speaking, we will look for that or look for the possibility of both of those to appear in the short term. So short term and then being pillars of strength for dividend sustainability going forward.
Yeah, well, we've got plenty of those stocks to go through, that's for sure. And how's that sort of strategy panned out this year in terms of that balance sheet strength and dividends in terms of sort of like, total return for investors?
Well, I can tell you not just this year, but every year since launch, which is 2011, that strategy has actually delivered in terms of outperforming the FTSE All-Share Index yield, which is essentially the yield test here in the UK. The Investment Association sets that for us. And total returns also very good. Year to date, up 10%. So that's top quartile for the fund. It's quite nice to be back in that regard, actually, because, after a bad 22, when people were forgetting about UK and small companies and there was enough doom and gloom, it's actually a lot better. And if you look at it since October, actually the returns are even stronger. So, they're sort of 25% plus. And, you will ask me, oh, well, how does it all look in terms of going forward? I'm sure that will be your
please do. Yeah, no, absolutely. What is your view for the second half?
And it's always very difficult to predict that, okay? But the backdrop does seem so much better. There are sort of uncertainties now that have been sort of looming for a while, which are out of the way. The UK general election is out of the way. There's been no shock result there in any particular sense. We know that the outcome was fairly well flagged. So I think that confirmation is a help. Interest rate cuts, again, on a macro basis, are expected. Inflation, you'd mentioned CPI in the UK is also on target now at 2%. So there's more reason for, I think, government we can get to. Rachel Reeves is supposed to speak at 12 o'clock today. So, we'll hear all about the first female chancellor's plans for growth. But that aside, I think Monetary Policy Committee, I think, has more reason now to look carefully at both unemployment and inflation together, which is very much Fed speak. In a way, the US Fed has already mentioned that. So I do think that there's a much stronger backdrop for equities, especially the UK again. So I think yes, I think there's been enough sort of false starts, enough hiccups, enough false dawns, doom and gloom. But I think now it's actually back to sort of companies, trading statements, results, all looking a lot more stable. I think that is the word, really. It's stable and perhaps the foundation for growth going forward.
Well, you're making me feel a lot better now because I'm looking for a better second half. And the thing that also, I guess the other thing about the UK attraction is the valuations compared to the US are significantly less, particularly in small cap land. So if you ever get a sort of a mean reversion trade, then that should perform well. In terms of that,
I didn't mean to interrupt you there, but this is a very important point you make about small cap, because you look at the last 2 or 3 years, and what's happened is, even just look at this year. You've had the FTSE 100 outperform in the 12 months that have gone by. Compare it to sort of 2021, and the FTSE 100 will be up. Or just look at it compared to the last high, and what you'll find is actually the smaller companies are still below that. Okay, so the mid-cap index underperformed, and it still has 15% to make up on that. AIM is even worse. In that the correction was so harsh that surely there will be some mean reversion. For that to happen, I'm not saying it's going to rally 30%, but your textbook theory tells you long-term average returns from equity markets 7% per annum. Well, I think that is perfectly possible, and it's probably more likely you're going to get in excess of 7% in a given year to make that average real, if that is to continue. So the smaller company indices, actually in comparison to FTSE 100, which has already rallied 15% above its previous high, if you have a look at that on a like-for-like basis with the smaller indices, that's had its run. So it's actually the turn, I think, for the reallocation, probably in that mid-cap, small-cap space now. AIM underperformed 2 years in a row, which is unusual. So this year, the fact that it's a bit better is no surprise to me. I think you will probably see, and again, nothing in a straight line, but you will probably see small mid-cap and AIM have their turn now. It just rotates. It happens.
Yeah, and I mean, there's another sort of indication of that. This morning, Carlsberg bid £4 billion to buy Britvic, didn't it? So the valuations are significantly attractive for overseas buyers to pick up effectively trophy assets in the UK.
Indeed, and we mentioned Wincanton with you in the last interview, and that's been taken over since at a big premium. And I know it's easy for fund managers to celebrate takeovers, but to a certain extent, it's also a very rapid shrinking in terms of the number of opportunities available then as a result. And you wouldn't get the takeovers if there was an undervaluation. I think that is clear. But you know, what I'm looking forward to now is sort of new ideas, new IPOs and placings and things like that, where actually the opportunity then refreshes. So you know, a 25-35% premium is nothing to really celebrate if you think you could make that in a year or two anyway.
I'll take that any day of the week, mate.
I know you would. But as investors with clear strategies, you kind of want to make that. You want to be able to say, okay, well, I buy into the strategy of the company and the vision, where at a capital markets day, you might get a company saying, I'd like to double my profits over 5 years. Well, theoretically, the share price should double over 5 years as well. And you know, it's buying into that vision, which is what I'm after, rather than the 25%.
Yeah. And just in terms of the sort of comment you made with Rachel Reeves, the new UK Chancellor, putting a sort of like a growth strategy and announcing it at 12 o'clock, hopefully this today. What kind of sectors do you think will benefit? Is it going to be the classic house builders infrastructure, or is it going to be something else that really sort of boosts and kickstarts the UK economy?
Well, on the property sector, I think there will be a new compulsory target. Now, that target of home building has been missed almost every year. I don't think it's ever been really achieved. 250,000 homes per annum. It might be 300,000 homes per annum. Even if it's 200,000 homes per annum, let's see if we can get there. So that's the first thing. And I think to achieve that, they need a few other levers to be pulled. So the planning system has to be not just eased, but I think invested in. So that's an area that clearly needs more resource. It's not because the talent who's sitting there don't want to do the applications. It's just it's literally that there's too many applications, too few people to process them, and so efficiencies there will have to be, I think, thought out quite clearly. Then there's aspects of grey belt, and I think perhaps even sustainable building. So that, let's see what the detail is on those. From the fund's perspective, we are quite well positioned for that particular sector. So
yeah, just on that one, you've got more. I know you've got Morgan Sindall in there, which is obviously a infrastructure play, but also does affordable housing, building. It's that classic sort of beneficiary of all that spend, isn't it? Can you just talk through your latest view on that? Because what was quite amazing was that even though the shares have ticked up of late, obviously anticipating this, they're still only on at about 11.5 times PE and pay over a 4% dividend yield.
Yeah, thank you. I mean, those are some of the attractive features about it. It's also got an average net cash position of about 380 odd million, which is useful. So that gives me that comfort, and comes back to the point about what sort of companies do we look for. Well, there's a strong balance sheet. It's got the cash flow as well. It's also got a number of different attributes to it in terms of the divisional spread. So if you look at it, it's got a bit of urban regeneration, which has had some timing issues. So you might argue, oh, is that the reason why it's in a single-digit PE? Well, actually, no, not really. You know, I think that's minor. It's been overlooked. The entire sector's like that. Galliford Try is very similar. Again, average net cash position. It's got exposure to the housing sector as well. But then you've also got the infrastructure, which you mentioned, Paul. So infrastructure will do very well out of from the AMP8 program. And I see both Galliford and Morgan Sindall in a similar way. It's sort of essentially playing the same theme, but they happen to be stock-specific selections for us, so they benefit from the same macro policy, if you like. fit out, again, who would have thought that fit out is a strong area, and yet for Morgan Sindall, which is the one you asked about, that is the area of strength. So they will continue to do quite well because offices have been reformatted. They have requirements through building legislation. There's a desire to have a sort of a greener certification, for instance. Working from home has changed the demands on office space, and so on. So, just to sort of think, oh, well, UK offices, surely that's a dead sector. Well, actually, no, there's a lot of activity there. And if there's change, even tenants moving in and out, that's very good for them. So record order books, actually, it's a 9 billion order book. If you think about that, big numbers.
Yeah, and the electric transition is going to be huge, isn't it, over the next decades?
Decade, and again, even there's going to be sort of stop-start. There's a lot of noise around EVs and what have you. So again, the infrastructure around that, I think, whether you're putting in charging infrastructure or something else, it's not all going to be sort of smooth sailing. I think there's a desire to do it, but with everything there are phases, and to a certain extent, it's healthy to have that rather than sort of all happen too quickly.
Yeah, I think if Rachel Reeves can manage to unlock private capital, overseas capital to build out infrastructure to help the housing market, I mean, it's a win-win situation for the economy, for employment, and for them, no doubt about it. Another one. Yeah, go on.
Sorry, I was just going to say that's only one sector we've talked about with Rachel Reeves. I mean, there may well be other areas that don't do so well, and I think there's a sort of a position for what you think will benefit and then avoid maybe or reduce in areas that you think might be under.
Which one would stand out? Perhaps is going to be hit.
Possibly
the rail sector.
North Sea.
Yeah. Okay.
There's the sort of aspect of incremental windfall taxes to be put on. So it's not really very, sort of, in my opinion, not very sensible if energy is an area that you're looking to have national security on. Surely North Sea is sort of the one asset that you really want to sort of commercialize properly and encourage foreign investment into as well. So with that in mind, we had reduced positions like Serica Energy, which had exposure to North Sea oil and gas. And actually, even on the day when Labour sort of came through with their manifesto, actually, this was a well-known risk, the shares still fell 10%. So, trying to manage that is difficult, and it's not great when it's a kind of an own goal, really, when you'll generate more revenue allowing these businesses to prosper through tax and everything else, sort of trying to put windfall taxes on. That's my opinion.
Yeah, no, I agree. Well, you never know. She might surprise us all.
Well, that'd be great. I like good surprise.
Another one in that infrastructure sector, you've got Hargreaves Services, which is a bit of a special situation. It's got three divisions. Obviously, it's got the sort of construction and that infrastructure services type business. It's also got a land property development business, and then it's got a materials recycling division out in Germany. Do you want to take? I guess this is a sum of the parts play. It's the shares have actually started now just recently, responding pretty well, actually.
When you say special situation, people often think of something that is beaten up, has profit warned, needs restructuring, possibly loss making. None of those are true with this one. Yeah. I think it's a special situation in the sense that it's a transition story where they used to have land which may have been considered more exposed to dirty fuel, coal, and what they've done is they've remediated that. And that's where, once you get the planning and everything else, you can actually do deals with the house builders and sell that on. So taking something that otherwise would have been wasteland and turning it into something commercial, which is, I suppose, solving a problem with the bottleneck, given the shortage in housing, and then making it affordable. I think that's sort of a win-win. You're right, on the raw material services, that's the German JV, that's where they get essentially a lot of cash flow from, prove it up, which is previously, I think, kind of being ignored or looked upon with a bit of suspicion, but it's been so steady and regular that that's essentially what's been funding a lot of the dividends as well. Yeah, so Hargreaves Services, very interesting business indeed.
There's still a long way to go, even after the sort of tick up. It's about 530, market cap round about 175.
Some of the parts you mentioned is a right way to look at it, and you could probably get to £8.60, £8.70 quite easily if you're talking about NAV. Right. That is not my opinion in terms of the models that I'm reading. And not that I disagree with it, but that's I'm taking sort of third-party analysis and quoting that. So yes, I think there is a possibility, but with NAV, there's always that risk that there's going to be a sort of a persistent discount. So I don't want to be one of those dreamers that thinks that you will get full conversion to NAV, even if it moves in that direction, and you make 10, 15, 20%. Well, that's showing you that there's embedded value. And then don't forget that the NAV will keep changing, because as they do more development work and complete more land for housing, that's where you get the bump up on the revaluation as well. So it's not a static NAV. I think if anything, the NAV goes up.
Yeah. Wow. I don't think anybody's accused of being of a dreamer there, Sid, because there's some very, very smart other investors on there as well. I think there's the Harwood guys are in there, quite a significant size. So I don't think you're definitely not looking at sort of like artificial value. That's pretty damn solid. Okay, let's move to some sort of really media trophy assets. We've got Games Workshop, which is really a sort of like a unique IP property. It does sort of like miniature gaming, hobbying for the Warhammer brand around the world. It had its own sort of shops for ages, but now has really started licensing out to gaming, but TV and films to Amazon and stuff like this. Can you take us through this one? Because I think it's one of the absolute real success stories over the past decade or so on the UK market.
Not a lot has changed in that regard. It's continued to do what it's kind of always done. It's been a specialist hobby business, if I can describe it like that, and it's very easy to dismiss, and yet it's incredibly resilient during the sort of the down market, as it were. There will always be a degree of client base that comes back and repeats, but the way they do it is quite, I suppose, it's subtle, because you start off with a particular age group, and as they grow older, they then graduate and spend more money on the more sophisticated and the longer games. So it isn't just painting. There is a lot of strategy and intellectual side to it too. And then, of course, there's the video game and the movie type revenue that you can get. So at the moment, there is talk of the 40K launch being very successful, or the relaunch, if you like. So that's fine. There's a halo effect. Then there's the potential TV series with Amazon. Who knows what that will be? We should get detail in due course, but it's been kind of they've been keeping it very close to their chest, and it's quite classic Amazon as well as Games Workshop in that they don't really want to tell you too much until it's done. Yeah. Dividend, again, very, very regular. Even though there is no formal schedule on it, you'll see that you get paid 2, 3, 4 times a year. On some occasions, they'll pay you specials if the cash is over 50 million. Any surplus is handed back. It's also very good with its employees. If you look at the latest update, they make a particular point about that in terms of the bonuses and how they want to look after their employees well. So it's not that it's just going to shareholders. I think the employees and staff are very important to them, and quite rightly so. 5%, I think, upgrade was the sort of general reaction to the last trading update. So moving in the right direction, net cash business, and it ticks all the right boxes for us.
And another indication of the quality of the asset, its gross margins are nearly 70%, and it makes over 35% EBIT margins, which says that it's got a lot of pricing power. So,
and they don't abuse that. They don't just put prices up for the sake of it. I think they're quite careful about how they do it, and if they find it's not reacting well, then I think they control the next release. So,
well, you imagine what the share price might do if they ever signed a deal with Apple for its metaverse product to basically allow all its gamers to go into a really sort of like, futuristic virtual world to be able to play it themselves. I mean, that would just be
I might have to try that. I'm not into painting figurines, but that sounds quite a lot of fun.
Well, I mean, Apple needs applications for its Meta device, which is fantastic quality. So it isn't like the usual sort of stuff. This is really top notch. Okay, another one, which is another sort of darling in the media area, is Bloomsbury, which I think was started out by the CEO Nigel Newton about sort of 25 years ago, and it's grown and grown and grown. It started off with obviously signing Harry Potter and J.K. Rowling, and then recently signed Sarah J. Maas. Those have done brilliant on the fiction side. And then just recently, the big news, I think it made its biggest acquisition, £65 million of an academic publishing business out in the States. I was just trying to remember, Roman and Littlefield. So can you take us through how you see this business? Because it hasn't really put a foot wrong either.
Yes, I'm glad you said that, because it was very easy to think that it's only about J.K. Rowling and Harry Potter.
Yeah.
And they've done is a lot of good work to diversify, grow the rest of the business. There's the academic publishing side as well. There's Bloomsbury Digital Resources, which feeds very nicely into that. As you said, the acquisition in the States, it means that they get, I think, another 40,000 titles, essentially on the academic side again. So that's that's usually the dream, isn't it? When a British company can go abroad and make proper strides in the States and be accepted for it. But this has been sort of ongoing, very gently diversifying away from the UK, if you like. There's something like 77% of its revenues are actually non-UK in any case, by destination rather than selling directly to them. But if it was direct sales, it would be a little over 55%, something like that. So with Bloomsbury, it's another one of those sort of, I don't want to jinx it, but it has been a sort of a gift that keeps on giving. It's been very, very solid all the way through. Sarah J. Maas, you mentioned, I think the Court of Thorns and Roses, I think that one was one potentially that could, you talk about TV series, that could be a TV series, but they're being very coy about timing. And at one point they said they would do it, and they said nothing, maybe it comes back. So again, that could be incredibly lucrative. And I think in contrast, am I allowed to say this? In contrast to perhaps what happened with Harry Potter, where they didn't really know how much of the rights to go for, and they'd only really kept it for the UK. Here, I think with Sarah J. Maas, it is more of a worldwide deal. So whatever they do together, I think it could be longer term quite exciting. And then there's Catherine Rundle, who's also not to be underestimated, another very, very interesting author. And you know what happens with these is, if you get a hit or sort of a title that works, it's the back titles then come back into demand again, and those are incredibly profitable. It sort of drops straight to the bottom line. You don't have to do any extra marketing for that.
Yeah, no, every time, like say for Harry Potter, every time Universal Studios put a new theme park ride on, the back catalogue sales of the books just go through the roof, no doubt about it. In fact, just to give you an indication, my daughter, who I started reading the Harry Potter series to, which was about 3 and 4, we bought all the books originally. She's got a sort of like a box set as well for her. And she's down to Milton Keynes and over to, and then we've got that other, I think we've got another Universal Studios Harry Potter thing coming in about.
That's two, isn't it? It's quite exciting.
Yeah, it is.
Very good thinking. Yeah.
Yeah. So yeah, you're right. The gift that keeps giving, no doubt about it. Okay, let's just move to distributors. We've got food distributor Kitwave, which I think is around about sort of the 15th largest food sort of distributor, impulse sort of distributor in the UK, to largely sort of convenience stores. Came out with a trading update just recently. Saw a bit of softness, surprise in its food service business because of the wet weather. There's less hospitality.
That very well. Yeah,
exactly. Yeah. And the shares sold off a bit, but they did hold their full year expectations. What's your latest on this one? Is it just a good solid business to keep going?
Well, this is one we've kind of supported since IPO, and I like the management team. They've been incredibly conservative pretty much all the way. They had a series of upgrades at a time when most companies were actually not delivering. So I can't forget that. This is the first time where there's been a bit of a query, if you like, from my side to say, well, how seasonal is it really? And they've always had a first half, second half split. So that's something that shouldn't be forgotten. And perhaps they should have actually spelt that out a bit more in their statement, which they didn't. Anyhow, it's due to one-offs. As you say, there's a bit of wet weather. There's a little bit on timing. I'm not especially worried. I think they have enough visibility in their own minds. I think they can't say that until things are done, but I know them to be a conservative team, so I'll be very surprised if they don't deliver the full year numbers like they've said they would. That's the first thing. Secondly, it is very cash generative. So I think again on that side, I think it's a sort of a 7-8% free cash flow yield business quite easily, which means that your dividends covered more than 2 times, a 3.5% dividend yield, rising to sort of 4-ish%. So you've got dividend growth on top of that. Again, the balance sheet is not stretched. You're looking at sort of, depending on whether you want to look at lease liabilities or not, be conservative, throw that in. It's still only forecast to have sort of 60 million in net debt next year, which, considering you've got a new DC, new distribution center coming online, and I think it'll ramp up very quickly, actually. You'll get the synergies and the benefits from that. Then you've got the acquisition benefits from the previous 12 months, which will start to feed through with synergies. Then there's a note actually out today, funnily enough, from Singers, which is showing how you could get a 5.5% upgrade on the back of all of this, which is not there yet, but they've described it as upside risk.
Yeah.
So shares are up 4 or 5% today already on the back. So I think it has oversold. But look, let them deliver. I think it's one of those with any of these companies, when you're looking at a full year number, until it's done, it isn't done.
Yeah, that's a really weird discussion, isn't it? So this description, upside risk. I just love risks like that. There's plenty of good potential.
Yeah, it's when people talk about reverse profit warning, and you're thinking, well, okay.
What's all that about? And there's obviously there's consolidation in the sector, isn't there, as well? So you never know what.
Well, it's been described as a mini Booker, which that's a huge compliment, because if you remember Booker, and we used to hold it a while back, it's now part of Tesco. Well, it could be, I hope not. That's one, again, you see, going back to the beginning of our conversation, I hope it doesn't get taken over. I'm sure some people will be delighted, but everything has a price. Maybe if it's 100% upside, we can talk about it.
You're a tough man to please there, Sid. Okay, let's do another distributor. We've got Midwich, which doesn't do impulse foods, but basically does audio visual equipment, professionals, basically, sort of concerts and corporates and stuff like this. Very high niche sort of stuff, more international, actually. I think it's got a lot of presence out across the world. I suppose it sort of boomed during the pandemic as everybody wanted audio visual stuff, and then has sort of come off a bit. What's your sort of your latest on this one? They're trading at 11 times PE, dividend yield 4% plus.
Midwich has been a little bit more frustrating of late, because it is a relatively illiquid stock. Actually, it's one we like and we've held for a while. If you talk about take our risk, it's greater there than anywhere else. So that's the one that I'm scared of, in terms of it getting taken out, because one more sign of weakness and it's possible. But there has been a softer market, and I think that's the reality of it. So can they manage it? Now, there's a lot of operational leverage in that business. So you get a sort of 4 or 5% top line decline in the UK, which is their higher margin business. I think that's what's, if you read the HSBC note, that's what's driven the downgrade of 10, 12, 13%. But that's in the numbers now. So it's theirs to make good on. It is an acquisitive model as well. They've done very well from that in the past. They're quite good stewards of capital. So let's see. I think ultimately it'll be dictated by, sorry, ignore that. It'll be dictated by the market for capex on such equipment, audiovisual, office spend as well to a certain extent, because they do some of the networking systems too. But then again, it is an acquisitive business, so you don't know what they're going to do next. And I think watch the space, because they just signed a contract recently with, was it Hive again? So each time they do things like that, and then there's new opportunities that open up. Midwich, we did actually reweight, just for full disclosure. It's been a bigger position in the past, and that's one that we sort of downsized a bit to reflect that risk. But I like the team. I think longer term it should be absolutely fine, and has taken market share. So that's the point, is that even though the market may have softened a bit, they're getting bigger. So when it does turn, you'll get a double whammy.
Yeah. Well, I mean, you get paid to wait, don't you? So it's pretty good.
Indeed.
What about pets at home? Obviously, it's a secular growth area, sort of companion animals, etc. But overhanging the whole of that sector, I mean, they're slightly different. But overhanging the whole sort of like vet sector is the Competition Markets Authority investigation into sort of vet pricing, and it's got a small vet business. Most of it's obviously it's retail stores, does foods and pet sort of products and stuff like this. What's your sort of your latest on this one? Because the shares did sell off a bit, but started to recover a bit as well.
Well, I really like the the team, the CEO, I think, and also the CFO. They know the detail of the business incredibly well. Their initial response to the CMA investigation was that actually what they are doing is already above board. It is already market leading in terms of standards. This is not a business that is trying to manipulate pricing in any way, shape, or form. If anything, they share the cost savings that they make with the customer. And a lot of the decisions are independent in any case. So if you look at their pet franchises, or even the vet franchise model, each vet can be free to do what they think is best for their client. So it's not really, or customer, it is not really down to Pets at Home to decide that. And the group is split very, very simply into two sections. You've got the retail side, which goes up and down with trends and, you know, sourcing and supply chain from the Red Sea and what have you, can be affected by the Red Sea, should I say. And then you've got, of course, the vet side. So I'm of the view, having heard from a former director at the CMA, that there will be a very fair process that is undertaken, and Pets will play its part in it. If there's a remedy to be more transparent on pricing, they will already be there probably, or they will make necessary adjustments. So this is less, I think, about, oh, we need to fine or stop any ill behavior, at least from the Pets at Home perspective. But there is a fear that, oh, you know, is this an industry in itself which is completely in trouble because of poor ethics, and you know, is it in any way, shape, or form like the funeral care market? And I think it is that fear and test that needs to be now proven that it is actually a very different industry, or that there are some good players, and I believe Pets is on the right side of it. But sentiment can be negative until all of that clears. So again, it's one we did reweight. It's a smaller position now, but it's very difficult to do that with a business this good, you know. And as you say, the stock is cheap. It's got a good balance sheet, basically decent dividend. Management team haven't done anything wrong. So I think they will continue to cooperate, and until you get sort of a full release of what is due on that, and what is required, you know, the shares may well tread water, but longer term it should be absolutely fine.
Yeah, I mean, I'm with you. You know, you look at the model which they currently have agreed and they're happy with. It's the pharmacy model. You know, basically OTC, you know, healthcare products. Well, the pharmacy can recommend whatever it likes in terms of, you know, you go to see one of the pharmacists behind the counter, and you pay the price there. And as long as it's price transparency and you can get these in multiple places, then frankly, I think that's the model. Like, it seems the practice. I can't believe the UK government is going to decide, actually, I want to insource all animal drugs and support and subsidize it, and to, you know, sell it on. It just seems, you know, that'd be a sledgehammer to crack the nuts.
I would have thought there are other sectors to go after, like tobacco, instead of the pet sector. But, you know, if there's something that needs fixing, it should be fixed.
Yeah, I agree. Yeah. Okay. Just on that sort of consumer sector, we've got Telecom Plus, which obviously benefited from that sort of cost of living shock. Still seems to be doing really well, actually. It just went through its millionth customer, just acquisition sort of stuff. It's a sort of like a end-to-end utility supply. So it'll provide households with sort of like power, you know, so gas, electricity, energy, telcos, insurance, all the kinds of stuff that it's going to need, wraps it all into a bundled offering. Can you just take us through your latest view on this one in terms of, you know, sort of like how you see that progressing?
There's a couple of changes. I think first of all, you're going to get a single CEO structure, which which is from so Stuart's going to be CEO on his own, which is great. He was COO before, and he's had time to settle into that role. I really liked Andrew Lindsay as well, who was the former CEO, if you like, went into co-CEO structure, then steps aside. I think it's more a principal point, which is it's easier to run a business single CEO than two CEOs, even though these two got on really well and did a great job together. So I liked both individuals. I think it's rare to find that where you can have two CEOs running a business well and not having any issues. But just for the sake of risk, you know, things can change. It's better to have one leader and one vision. And they've set new targets now. So instead of 1 million customers, they're trying to go for 2 million customers. And so quite nicely, it goes back to my earlier conversation about I want to be there for that doubling call. I don't want it to be taken out, for 20% later. It needs to show that. And the offering has improved. They've got a new deal also with Npower or E.ON, where there's more flexibility to offer fixed price tariffs. So as the energy cap drops, there will be customers who want to lock that in, and that's fine. And I think having different offerings, different tariffs for different customers is right. They also won best value for the energy sector. I think quite recently they won an award on that, so that's a good sign. Partner sign-ups, which is essentially it's a model that relies on self-employed individuals to go and sell the product. And as the CEO used to say, are you going to be comfortable enough selling this to your own grandmother? And if you can hand on heart say you are, then you're doing the right thing and you can carry on doing it. And so that's the way they really pride themselves in saying this is a utility warehouse product and we vouch for it. And to that end, I think there was a bit of a query. There was one complaint on the insurance panel. They've only got 12% of their client base looking at insurance. And they immediately went voluntarily, I think, to talk to the FCA about it and stop selling insurance products. So it's very important to their DNA, if you like. Now, some will take that very negatively and go, oh my goodness, that's happened. So, but they're not even factoring in any growth into the insurance sector until they fix it. So I like that prudence. Yeah. Now, if it's more sinister than that, we'll find out. But for now, that's my stance on it. The rest of the business is doing perfectly well. And I think, again, there's a market share grab to have. The offering gets better. E is a partner on the mobile network. I use the offering myself, by the way. I'm a customer, and I have been for a while, and I think it's great. You get all your utility bills on one page. So, whether it's gas, electricity, or broadband, mobile, it's all there. And, it's very convenient, and I feel very safe with them, actually.
Yeah. Well, it saves you time, doesn't it? You haven't got to sort of shop around, and you get the best deal, and it helps the company. So it takes out the intermediary, doesn't it?
Yeah, and I think there's now a cashback offer as well on it. And so, they're constantly trying to improve things, trying to make it interesting so that they can get clients happy.
Well, you should be one of those partners of it, sort of, Sid. You can add me to it because I'll sign up.
All right, I'll send you the link. We'll make 50. Okay. How about that? Okay.
You can get a tenner from me or whatever it is. Okay.
For the rest of my life.
Yeah, exactly. Yeah.
There you go.
Okay, let's just find this final section. We've got financial services, one of the fund managers, Liontrust Asset Management. Can you take us through this one? I mean, when you look at the numbers, it just looks crazily cheap. Under 9 times PE, pays 11% dividend yield, if you can believe the numbers. Got cash on the balance sheet. I guess if the markets turn, these things are going to be a big beta play on it.
This is a sort of you talk about special situation. This may be the special situation of all of them. And I say special with the emphasis on that word because it was a business that was so loved for a number of years. They could do no wrong. And then along came the GAM acquisition, which didn't work out for them. Yeah. And everybody hated them. And I say that as a sweeping statement, but the FT was very negative about them, has been for a long, long time, ever since. There were outflows. Suddenly, analysts who used to cover them rather favorably went negative. There's one in particular who's been a perma bear on the stock. So there's a lot that suddenly got questioned. It was like even the previous acquisitions were now expensive. But to put into perspective, the acquisitions made in the past, when markets were higher, were done at that price, thinking with an assumption incorrectly now that there would be some extrapolation and they would get synergies and they would get inflows and growth. Markets collapsed after that. You've had COVID, you've had a lot of setbacks since. So the UK went into outflow mode for a while. So clearly it looks expensive in retrospect. And I think if you take the low point in any market, most acquisitions will look expensive retrospectively. What I think they've done now is quite smart. They've started to recruit in the distribution sector. So the point being, good marketeers, good distribution managers who I think certainly if you look at Liontrust in the past, that was their strength. That was always their strength. Yes, they had funds that could perform, but you combine the two, and you've got a business now that is trading on what 1.74 percent of AUM. You talk about PE, I look at fund managers on percentage of AUM.
Yeah, no, it's got 1.2. Yeah, you're exactly right.
Yeah. So if you look at that, it's 1.7% of AUM, and that's too cheap. It's way too cheap. It should be probably on 2.5, 3 times, or 3%. And you know that means you could double. You could actually double from here. There's so much operational leverage in that business. So if you're now recruiting managers from GAM instead of buying the business, and you're getting a follow-on with people joining you of their own accord, well, that's quite a smart reply, you know, because you don't have to pay for that in any extra terms. There's no goodwill. So there were, I think when the results came out, there was probably too much focus on a statutory loss, which had been an extension from the previous half. So there's like a statutory loss of 0.6 million or something. But that's finished now. In the next period, you're going to see some strong numbers, I would imagine, because also the comps get easier, and they haven't made any acquisitions to speak of since. So, you know, I think it's quite an exciting time. And like you say, there's a lot of beta behind that. We also have Polar Capital, which is much more international, different client base in terms of the investors, and more institutional, not retail. Whereas Liontrust is much more about the UK. It's more about the retail investor base. And I think having both in the portfolio is quite useful. You cover the entire spectrum.
Yeah.
So that's why it serves a purpose. Exactly, for us, that's why it serves a purpose. And you talk about, can you believe the yield? Well, Polar Capital is also in a high yield, and you should believe the yield because they maintained it. You know, so they've got the net cash to follow it up. You know, if they didn't have the balance sheet, they'd say, okay, fine. Do we need to worry about the dividend? A very good business confidence signal, Liontrust. It's telling you that we're excited, we're ready to go again. They just won an award recently, didn't they? The European Fund Manager of the Year awards. They won that, and you're not going to win that if your performance is rubbish. So ultimately, if you get good performance, you get good inflows going forward, more interest in the funds, more AUM, more fees, the multiple re-rates over time. This is another one that if you'd gone with all the negative sentiment, you'd have missed the 60% run off the low in the last 6-7 months. So it's quite a big rally. Now it's come off a bit, but it's still up 30% off its low. And you could have done the anger trade and just sold out of it and said, oh, you know, they're disappointing. It's not the same anymore. AUM's lower and they've had net outflows. And, okay, but you would have missed that entire run then.
No, it's amazing, isn't it? You get a 60% rally, and they still haven't benefited from the inflows yet. So
that's not even started yet.
You've got it all. You've got that all to come. Okay, to finally finish, let's go to a larger position. We've got Paragon Banking, which is basically like a bit of a challenger bank, does sort of like buy-to-let mortgages and commercial lending to, I think, to small businesses. It's trading above net tangible assets. What's sort of the USPs and attractions of Paragon?
Excellent management team. It's another Nigel who runs it. And long-standing. Don't underestimate his CFO either. But Paragon is, again, this is a company that is very well positioned for a stronger economy, if you like. There's been so much fear around buy-to-let in the property market that actually they've taken share, and they've shown that they can prosper even in a difficult time. Net interest margins were better than expected. There were upgrades on the recent results. Dividend very strong. Paragon is a very special company. They had, I think, if you go back 7-8 years ago, they had almost no retail deposits, and now they've got 16 billion in retail. It is more of a commercial lender. Okay, so I don't want to sort of put too much on that, but the point is their sources of funding has changed, and then you've got these older loans which were from the perspective of Paragon's margin, lower margin. And as they roll off and you do the new loans at better rates and better spreads from the combination of being able to borrow better, but also lend better, your margin expands. And I think that's the story that I'm in it for, is that longer term, you've got all these extra. So the loan book, the quality of the loan book is getting better and better. It's getting higher and higher margin as a result of being more selective, underwriting better, getting better sources of funding, but also being able to essentially not lend at rates that are unattractive.
Yeah. They haven't got any exposure to what the PCPs have, the vehicle stuff investigation. I know Lloyd's has got hit a bit, and some of the other lenders have.
No, they have disclosed where they've got loans on motor, but it's very low. And it's I mean, that was a question that we asked, and I think if you find anything on it, it'll be very low single-digit millions. It's not a material part of their book at all.
Brilliant. Okay, great. Well, thanks very much. Just in terms of exiting any positions, have you sort of like have you decided to sort of top slice or take anything off the table on certain areas?
I'm laughing a little bit because it's always one that you kind of think, am I going to regret saying this in public? But yes, we took a sort of a 30% profit in M&S. The yield
well done.
It's also for T100, so it was a nice opportunity for me to book that and come back, rotate the capital into smaller mid-cap companies for the reasons I'd explained at the very beginning. Yeah. So yes, so that was done. Then on the less exciting front, we exited 2 Georgian banks, trying to keep the profit, and that was because there's been a bit of unrest in Georgia, sadly, around what's known as foreign agent law. So Bank of Georgia and TBC were both correcting quite quickly. I didn't want to sit around and wait for that risk to play out. The way I see it is, got very good ratios, very good solvency, but it'll be ignored until the geopolitics settles down. So I don't want to be trying to take on market sentiment. So we decided to book that and sort of got out with a 15% profit rather than a 35% profit, which is unfortunate, but at least it's still a gain.
Yeah.
And then Shoezone I sold as well.
Oh, okay.
Prior to the profit warning. And
you gave that the boot.
Very good. Nice pun. Part of the reason for that was, and this is prior to the profit warning, it was, we got the sense that the CEO at the time was not really interested in playing his part with the city. And that's fine from layman's speak, but if you're a PLC, there are duties and governance, and there are issues there that I think you've signed up to.
Yeah.
It sort of take the capital at IPO and then say, okay, well, now I don't want to play the PLC game. I just want to focus on the ops, and then profit warn after that is a little bit strange. So it's a very unusual thing to do, and I think that it just shows that it actually will create a seller. It's not to your benefit. So I don't know what the rationale is there.
Yeah.
And I think one thing I have learned is try and avoid giving too much benefit of doubt. If you don't like something, you're not the management team. So
that's a really good point.
Yeah.
I would agree. Yeah. When management teams go quiet, you just got to question why. It may be positive reasons, but you just got to think, actually, just sort of look at all potential options.
Yeah, it's a shame because we want to support these types of smaller company, and it is UK, it is retail, but there's a story to tell there. I feel bad for the rest of the business because the employees are innocent, and I think there are other shareholders there that haven't done anything wrong, and it seems like it's sort of one ego in the way.
Yeah. All right, brilliant. Well, thanks very much for all the excellent insights there, Sid, and very much look forward in touching base at the end of the year when hopefully we've had another good 6 months period. So yes, thanks indeed. Again.
Thanks a lot. Thanks, Paul. Appreciate your time. All the best.